New construction 2023, let's talk about it. Now, Edge Homes, which is a good sized builder here in Utah Valley, in October, they had an inventory of about 650 homes. And at the end of March of this year, their inventory is about 27 homes. So they've pretty much cleared out all of their inventory. Now, as a home buyer, that's good and bad for you. It's good because they've already reduced their prices and they have some pretty good incentives. It's bad because these builders are no longer in a big rush to sell, because most builders have stopped building in a big way. So now they don't have nearly as much supply, but the demand has pretty much stayed the same. But the key to doing this well is to talk to multiple builders and shop them all out. Once you do the legwork, you'll be able to identify what deal is going to be best for you and your situation. What are the best new construction incentives that I've seen over the last 6 months? And to preface this, I think it's important to understand that the best deal isn't necessarily the deal that's dropped most on its price. For example, if I'm looking at a brand new Honda Civic, one dealership is charging 37 grand and one dealership is charging 28 grand. I would rather pay full price of the 28 grand than get a $5,000 discount of the 37 grand and end up at 32. The same applies to builders. It's not always who's willing to give you the best discount, but where can you find the best value. But I have seen builders drop as much as 80 grand on their asking price. This tool can save you thousands of dollars on your first 2 years of your mortgage. And the best news is, a lot of times the sellers are paying for it. You see, sellers are really wanting to stay tight on their prices. Over the last couple of months, we haven't seen them drop as much on price, but buyers are still able to get a lot of concessions. One of the most popular concessions is a 2-1 buy down. Now let's pretend interest rates are at 6.5. With a 2-1 buy down, your first year, your interest rate would be at 4.5, and your second year, your rate would be at 5.5. And after that time frame, your interest rate would stay at 6.5. That helps keep the payments much more affordable on the front end of the loan. And if rates were to drop sooner than that, a lot of the lenders that we work with would actually prorate the amount that was paid out for the 2-1 buy down and apply that towards your new loan. So if we do see a rapid increase in rates anytime in the next 2 years, you still get to benefit from that. Let's talk inflation and real estate. You see, what caused the halt in the market was the fact that interest rates started to go up so quickly. And the reason interest rates started to go up so quickly is because the government is trying to combat inflation. So to do that, they actually need to slow down the economy and they need to have unemployment numbers go up. Yes, the government's goal is for less people to have jobs right now. So in this case, bad news is good news and good news is bad news. So as we see other bad things happen in the economy, that most likely means interest rates are going to start going down. And if we just continue to see good things, that means interest rates will continue to go up. It's kind of crazy how it works, but if you have a very clear buy box, you can win regardless of what the economy is doing. I'm going to take a scenario that I just crunched for one of my clients, and I'm curious what you guys would do. My client has about $300,000 in equity on their house, and he wants to do something smart with it. An idea that he shuffled around was selling his current house, buying another similar home with a much lower down payment, call it 50 to 100 grand, and now he's got $200 additional thousand to do something with. And his idea is to then buy 2 or 3 additional rental properties as well as a primary residence for himself. And let's say the rental properties taking themselves out. They don't produce a lot of additional cash flow, but they don't cost him any extra on a monthly basis. But his monthly payment on his primary residence would go about $1,500 a month. Now with the monthly income that he has, he can very reasonably afford that. And now he has 3 or 4 properties leveraged, which means he has 3 or 4 properties that are having the mortgage paid off on a monthly basis, 3 or 4 properties that get tax benefits. And when prices start to go back up, 3 or 4 properties are going to ride the wave with it. And when interest rates go back down, now all of his properties will cash flow and his personal monthly payment will be reduced. Now the question is, do you think that's a risk you would take? Would I buy a property that doesn't currently cash flow? Now the answer to that question vastly depends on what type of investor I am. Although I typically try to push people away from this idea, I've still had a good amount of clients that really like to buy Class A product that serves much more of a role of just curbing against inflation than actually cash flow. And usually these clients like to buy newer Class A products. Now I can't necessarily argue with numbers because these guys have actually done really well over the last 5 years. But me personally, I do like to leverage on a higher level. And so although $300 a month may not seem like a lot, if you multiply that over 10 or 15 property, that's $3,000 to $4,500 additional I'd have to pay on a monthly basis. So my take is if I can't scale it, then I choose not to do it. So because of that, my rate of growth might be slower than some of these other investors. But if things were to take a sharp turn, I'd be pretty comfortable where I'm at. So my way of answering the question is, yes, you can buy some properties that don't necessarily cash flow, but only if you have a good amount of money piled away to weather any potential storms. I've had an increasing amount of people talk to me about investing out of the country. And to be honest, this really depends on a country by country basis. And I know I always talk about the 4 pillars of real estate, which are cash flow, appreciation, debt pay down, and tax benefits. But when I'm looking out of country, to be honest, one of the first things that I look at are the tax implications of owning this property and the income that comes from it. Some countries will charge you both ways. So you'll get charged local taxes in that country, and then you'll get taxed as that income comes to the US. And although I could run a million different scenarios and talk about when it does and doesn't make sense, the biggest question I ask my clients is, do you eventually want to live there? If the answer to that question is no, then my take is just buy good, solid deals here in the US, and then with that extra cash flow, you can go out and stay in these other different countries and just stay at somebody else's Airbnb and let them take the risk on that property.